In the previous video briefing, I discussed two scenarios, one where the price extends up to the top of the channel and another where it bets on a subsequent decline. The chart is unfolding just as outlined in those scenarios. During the briefing, I once explained the importance of the liquidity zone. Today I will tell you not only about the liquidity zone, but also about the areas where real money actually flows in. First, to briefly explain again what a liquidity zone is. A liquidity zone is an area where a large volume of traders' orders are concentrated, and it's a price range where transactions can occur actively. Rather than simply being a place with high trading volume, it's a concept that refers to zones used by major players to accumulate or offload large positions. I refer to the liquidity zone as the retail camp. This is because you can identify the leveraged positions of individual traders, and large players may move the price toward areas with a lot of retail positions in order to liquidate them. The key information you can gain here is an understanding of where the price wants to go. In trading, knowing the destination is extremely valuable information. Once you've identified the destination through the liquidity zone, it's time to observe the movements of the major players. Here, the major players refer to the options positions. To explain why options positions are considered the major players, institutions or asset managers never hold only spot products or only futures products when they invest in a certain asset. They thoroughly calculate risk, including spot, futures, and options, and hold positions based on a portfolio approach. In the process of building a portfolio, options are naturally incorporated, and large volumes of options positions indicate the positions of major players. Let me give you an example based on the current situation. The max pain point is set at 70,000, and in this range, options buyers suffer the greatest losses while option sellers gain the most profit. One thing you should know is that large institutions tend to steer the price toward the max pain level as the expiration date approaches in order to maximize their profits. This is because individuals usually buy options while institutions sell them, so institutions benefit when the price enters the max pain zone. Right now, Bitcoin is priced at 71,000, and it seems there is an attempt to induce a downward trend to keep it around 70,000. Looking further at the options volume, there are large call positions waiting at 72,000 and 75,000. The 75K level overlaps with the 1-month liquidity zone. In other words, 75K is the final destination of the upward trend, and in order to break through this level, the big players would have to pay an enormous amount of money. The big players are limiting the maximum rise to 75K and want to keep the price around 70K. If it reaches 75K, it will enter the liquidity zone, and at that point, we can already anticipate that the market will reverse with a large-scale liquidation. We have identified the intentions of the big players and even figured out where the vulnerable zones for individual investors are. In the next video, I will explain how to find entry points based on the information we've gathered so far. Thank you.